Hi, everyone. I'm Gene Goldman. I'm the Chief Investment Officer for Cetera Financial. Welcome to my presentation, What a Long, Strange Trip It's Been. So for this session, we're going to do something a little bit different than our normal presentation. I hope you like it. We're going to talk about music. We're going to talk about the Grateful Dead, but we're going to tie it into our market themes. So I know a lot of you are music lovers, and in particular, if you're a fan of the Grateful Dead, you know the title of my presentation, What a Long, Strange Trip It's Been, because that title comes from the Grateful Dead's second compilation album. So let's talk about the Grateful Dead for a few seconds. So the Grateful Dead, as you may or may not be aware, their music has been amazing. It transcends time, space, and age. So we're all on the same page. The Grateful Dead was formed in 1965, and you see them right here. You may be aware, but in 1995, Jerry Garcia passed away. So to continue this great music, this soul-searching lyrics, the surviving members of the band and John Mayer, as you see here, formed a band called Dead and Company. So you think about this, the Grateful Dead has now become the band called Dead and Company. Then this past June, Dead and Company played their last show in their final farewell tour in San Francisco. And basically, they're never going to play again. This is their final show, completely done. And they played it in June of this year in San Francisco. And the reason they did this is that they wanted to commemorate that with the fact that the Fed was going from raising rates to pausing rates. I know that seems a little bit of a strange connection, but just hear me out for a second. So as my role as a chief investment officer, I am watching the Fed carefully because the Fed is so important to the markets, to the economy. In fact, there's the old adage, bull markets don't die of old age, but rather they're killed off by the Fed. The Fed is so extremely important. For me, in my role, I see the Fed everywhere. I see the Fed, when I turn on the TV, when I look on my computer, when I read a newspaper, the Fed is everywhere. In fact, I see the Fed in places you don't expect to see the Fed. For example, in my last flight, I live here in California. I jumped on the plane at LAX, I buckled my seatbelt up, I look up and immediately I see the Fed. I see the Fed everywhere. More importantly, though, the Fed is in places that you don't expect to see the Fed. Here's a great example. In, I think it was May of this year or June of this year, May actually, the head of the Fed, Jay Powell, that's him in this orange cap, he was spotted at a Dead and Company concert. So he's enjoying the music from the Grateful Dead, from the Dead and Company. And I think it's kind of funny how times have really changed. Long time ago, Grateful Dead concerts used to attract the Feds. Today, they attract the Fed. So with that as a backdrop, just like the Grateful Dead, since March of last year, it's been a very long, strange trip for the Fed. Strange in the sense of how aggressive the Fed has been. You look at this slide, and I've showed you this slide before, but it's so important. This shows the Fed funds rate. This is the rate the Federal Reserve, the Fed, uses to either slow the economy down when they raise the rate or to accelerate the economy when they lower the rate. And basically, they do this because if inflation is too high, they slow the economy down. If inflation is too low or economic growth is too slow, they lower this rate. To show how aggressive the Fed has been, you look at those two red arrows. The red arrow in the middle shows the last rate hike cycle. So the Fed went from 0 to 2.5% in about 3 years. As we've talked about this before, the hiking cycle that we're in now, they went from 0 to 2.5% in 6 months. And today they're at 5.5%. So it's been a very, very aggressive rate hike for the Fed. So with this as a backdrop, let's talk about our themes, our investment themes. And when we started 2023, when we started this year, we said 3 things would happen. Number 1, the Fed would pause. Basically, that means that the Fed would stop raising rates, maybe pivot. That means the Fed maybe cuts rates. Our second theme was that upside surprises were possible. What does that mean? That really means that economic data comes in better than lowered expectations. Basically, with pessimism around the economy, around banks, around the Fed, that economic data would slow down, so much pessimism would be in the economy and the market, and the data would become better and better. Our third theme that we laid out at the beginning of the year was that market volatility would surge. These big swings in the market will be a commonplace. As we look back, though, at these themes, really 2 out of 3 themes have played out. First of all, the Fed has paused, and this is pretty clear. I'll talk about this in a second. Second of all, upside surprises came in. The economic data has come in much better than expected. Where we were wrong is that we did not expect the data to come back as quickly as it did. And we'll talk about this a little bit later. The third theme, market volatility, until recently has been pretty tame right now. But again, really, market volatility did not surge as much as we had anticipated. So now we're, about 10 months through, 9-10 months through. And let's kind of talk about what are our themes on a go-forward basis. And we've tweaked our themes a little bit to better reflect the data that we've gotten lately. So our three themes are very similar, but a little bit tweaked. Number one is that the Fed will pause, but maintain a higher for longer risk. What this means is that the Fed will won't keep raising rates. We think the Fed's done. We don't think the Fed will raise rates anymore, but maintaining instead a higher for longer perspective. The second theme is that we think the equity markets have gotten a little ahead of themselves, that they're a little too aggressive. They are really ignoring some fundamentals that maybe could result into a market pullback, more volatility, maybe a correction. And we're seeing some of this already in today's market. Third of all is that any uncertainty will be short-lived. This is the good news. Even if we have a pullback, even if we have volatility, even if we have a so-called correction where stocks fall from peak to trough 10% or more, we do believe it'll be short-lived because the markets tend to look ahead at events coming down the road. The markets tend to price in events about 6 to 9 months in advance, and we foresee a better 2024. So what I'll do for this presentation, and again, this is the reason why I brought the Grateful Dead into our conversation. I'm going to dive into each of these three themes, but to help me, I'm going to grab some inspirational help, some soul-searching lyrics from the Grateful Dead to explain these three themes. Hope you like it. So let's start with this lyric. This lyric comes from the song Franklin's Tower. The lyric is extremely simple. It's this: if you get confused, listen to the music play. In my opinion, this is a perfect inspirational message to the Fed. Basically, the Grateful Dead is saying to the Fed, you have raised rates so much, so fast, it's okay to stop and take a pause and see the effect on the economy. We all know it takes about 12 to 15 months for a rate hike to fully impact the economy. We have still not yet felt the full effect. Remember, the Fed just started raising rates in March of last year. So we still haven't felt the full effect on the economy. So therefore, the Grateful Dead is saying it's okay to pause and listen to see how rates have affected the economy, how quickly these higher rates are slowing the economy down. So this is our first theme. And our first theme is simply this: the Fed is pausing. We don't think the Fed's going to raise rates, but they will maintain a higher for longer risk, basically keeping rates high, but not raising them more. So let's talk about this. So if you look at this slide, obviously the optimism around the Fed pausing is really driven by inflation. So you look at this slide, and most of my slides, as you know, are pretty similar. Horizontal axis is time, vertical axis explains an indicator. So this slide shows what's called the Consumer Price Index. This is a common measure of inflation. It's measured every month. Basically, it's a basket of goods, and prices are measured month over month and, of course, year over year. What you see on this slide is that inflation has slowed down pretty quickly. So whether you look at trailing 3-month, 6-month, 9-month, 12-month, inflation has come down, and we show it in this red arrow. This is the optimism around the Fed pause. The optimism is the Fed is done raising rates because inflation is rolling over pretty quickly. But the question you have to ask ourselves is, well, it's inflation, clear inflation is slowing down. The Fed is doing a good job. The Fed is pausing. If they're accomplishing their goal of slowing inflation, why not just cut interest rates? Why not? Well, there's three reasons why the Fed just can't cut interest rates. Number one, you look here. This is a very busy chart, but this chart shows that inflation levels in the United States and throughout the world are still too high. You know, the Fed has a target. The Fed's inflation target is that inflation, they want a 2% target for inflation. They don't want it to be too much higher. So their target is 2%. And you look at this slide, the horizontal line shows a 2% target. And each of those wiggly lines are inflation levels at different countries, major countries, France, Germany, United States, for example, Canada, for example. And what you see is that inflation, while it's come down, it's still well above the Fed and most central banks' targets. So the first reason why the Fed is not cutting rates anytime soon is inflation is still above their 2% target. The second reason you look at this slide is that services inflation is still pretty high. So inflation overall is rolling over quickly. We talked about this already in CPI, but let's break out inflation into two components: services and goods inflation. The dark line is goods inflation. Goods inflation has gone up, now it's come down. Services inflation, that light blue line, and this is inflation at bars and restaurants, when you hire a plumber, you hire an electrician, financial services, all these different services out there. inflation is still pretty high. That light blue line shows it's still extremely elevated. That's the second reason. Again, first reason is that inflation is still above 2% target. Second is that services inflation is still very high. And the way you drive down services inflation is simply what you have to do is slow the labor market, because basically labor is a big component of services inflation. Now you look in this next slide, the third reason why the Fed is likely to keep rates higher for longer is simply this. Jay Powell, the head of the Fed, is a huge fan of Fed history. He likes to analyze the mistakes the Fed has made in the past. You look at this chart shows two indicators. It shows the dark line, shows the Fed funds rate. Remember that rate the Fed uses to move up and down? The light blue line is inflation. If you look at the big red circle on the far left-hand side, that's when Paul Volcker led the Fed back in the 70s and the early 80s. And Jay Powell, the current head of the Fed, talks about what happened then many times in his speeches, in his conference calls, in his commentaries, in his perspectives. He always discusses the mistakes the Fed has made in the past. And that red circle shows the Volcker mistake. What happened back then? Inflation surged. Paul Volcker, the head of the Fed, raised rates dramatically. Then inflation started to slow down. Then he cut rates dramatically. That's a purple line going up and down in the red circle. But then inflation picked up again. He had to raise rates dramatically. And you look at the financial markets back then, the stock market, the bond market, they were going all over the place. So basically what we're seeing here is that the third reason is that Jay Powell, the head of the Fed, does not want to make the same mistakes that the Fed has made in the past. So he wants to make sure that rates are staying higher for longer in order to make sure inflation does not return and surge dramatically. So keep in mind, through all this thing, what we're watching carefully with the Fed has historically made a ton of mistakes. Something I showed you before, but this is such an important slide. This is from our friends over at Principal Investments. And this slide shows all the mistakes the Fed has made when they've raised rates. The Fed makes a lot of mistakes. If you look at the last 15 rate hike cycles, so this is groups of times when the Fed has raised rates, 11 of the last 15 times, they've made a policy error. A policy error is just a mistake, either a recession, a crisis, an issue. The Fed has a really poor track record. So the first theme is, number one, is that the Fed will not raise rates. The Fed is pausing. The Fed is done raising rates, in our opinion, but they will maintain a higher for longer perspective because inflation is still too high, still above the target. Services inflation is still pretty stubborn. And of course, the third reason is that the Fed does not want to make the same mistakes they've made in the past. So that's the first theme. So the second theme, I'm going to turn to this lyric. And this lyric comes from the song Casey Jones. And it's a very simple lyric. I know the song Casey Jones has a lot of interesting lyrics, so please ignore that other stuff. But the key lyric from Casey Jones for my presentation is this: Casey Jones, you better watch your speed. So in my opinion, this is a perfect Grateful Dead message directed to the stock market. So think about this. The stock market today is up about 10%. It's had a great rally. And it's really gotten ahead of its fundamentals. Basically, it's moved ahead because you've had a banking crisis, you've had concerns about a recession, you've had an aggressive Fed, you've had all these potential bad news. The stock market has rallied despite all this uncertainty, despite all this bad news. So in fact, I think a better title for Grateful Dead, a better lyric for the song would have been Dow Jones Industrial Average, you better watch your speed, because the markets have gotten ahead of themselves. So again, despite the Fed, banking crisis, concerns about a recession, the markets have really rallied this year on optimism about the Chinese reopen, which has actually slowed down a bit, on optimism around energy prices like natural gas coming down dramatically, which helped Europe avoid a deep recession because basically less money was spent on fuel costs. Interestingly enough, we talked about this before, but we had a very warm winter. This helped basically reduce spending costs on fuel. People spent a lot more money. Consumers were extremely strong in terms of their spending. Again, this is another reason that's driven the market this year. And the last reason, probably the one that you hear a lot, is AI. So much optimism around artificial intelligence and the opportunities. And there is opportunities. I saw a study from McKinsey that came out that said by the end of this decade, AI, artificial intelligence, should increase global productivity by about $4 trillion. Just to put $4 trillion in perspective, that's the entire size of the United Kingdom economy. That's a huge amount. So AI is definitely important, definitely a reason why markets have had a good run. But again, the key point, The second theme is that the markets have had a good run, but they may have gotten a little ahead of themselves, why we may see a little bit of a pullback, maybe of a pause. So let's talk about why. First reason, you look at the slide, and this slide, it's a simple slide, but it's very complicated. It shows two data points. The blue line is earnings for the stock market, so earnings for the S&P 500, and then the purple line shows market returns over the last 12 months. What you want to take from this slide is that basically the markets have gone higher, earnings have been flat to slightly higher. So if you think about the world of investing, earnings drive stock prices. If a company generates more earnings, investors tend to buy the shares of those companies. There's some assumptions in there, but basically earnings drive stock prices. What you see is that earnings have been up a little bit, but the stock market has gone up a lot. What this, in our opinion, is that the markets are just moving higher on pure multiple expansion. And that's just a fancy term for saying markets are just bidding up stocks in anticipation of good news down the road. So this is one of our concerns, that fundamentals are not strong underneath the market. Another concern that we have is something called market breadth. The stock market is up, as I said before, about 10% this year. And usually when you have a rising stock market, you want more stocks appreciating in the same direction. That's called positive market breadth. That's good market breadth. But what you're seeing now is that market returns have been dominated by very few stocks. So you've heard this in the news. The top 7 stocks, the mega cap 7, those big 7 stocks are driving overall returns. It's true. It's a very narrowly focused market. And I'll show you some examples. But if you look at a simple stat, market breadth, what this slide shows, slide shows the purple line shows the S&P 500 return. This is that broad stock market benchmark. But then if you take the stock market, the 500 stocks, and you divide it equal weight, so each stock gets the same weight within the index, you see that light blue line stocks are actually negative for the year. So what does all this mean? Is that basically the largest, biggest 7 or 10 stocks have really driven the market return, and the rest of the market has not appreciated with it. Basically, fundamentals have not been that great. Let me show you a better way of saying this. You look at this. This shows the top 10 stocks in the S&P 500, and you can see that this has grown dramatically. The top 10 stocks, there's 500 stocks in this index. The top 10 represent about 33% of the benchmark of the index. That's a lot of concentration. That's not a sign of a very healthy market. Another sign of a poor market is sector concentration. So you think about the S&P 500, there's 11 sectors. So basically what that means is that the S&P 500 comprises 11 sectors of our economy, like financials, technology, healthcare, industrials, all these different sectors. You look at this slide though, 3 sectors, consumer discretionary, telecommunication or communication services, and technology, all represent about 48% of the index. Again, a very concentrated index. So all we're saying is that the markets have had a good run, but if you peel back the cover of the market, that there's a little bit of not so great fundamentals underneath. And this could result, and it has started to result with what we've been saying for a while, is in a market pullback, in increased market volatility, or at the minimum, a sideways market, a market that moves up and down, but kind of stays sideways for a while. So that's our second theme. First theme, again, is the Fed pauses, but stays higher for longer. A second theme is that the markets have gotten a little ahead of themselves, and a pullback, a correction is likely, and that's kind of the bad news. But now let's go to our third theme. Our third theme is the good news out there. So for this theme, I'm going to also turn to the song Casey Jones. And I think this inspirational quote is directed to all investors. This is directed to you, to me, to my mother, to everyone out there as an investor today. It's a very simple line. Trouble ahead, trouble behind. So what does this mean? It means that mainly that I talked about all the trouble that's basically potentially ahead of us, like all the poor fundamentals, maybe a recession, maybe the Fed is higher for long, all this potentially bad news. But what happens if the trouble is already behind us? What happens if we've already seen the bad news and we're starting to get out of this? Basically, the point here is that the stock market is really a forward-looking mechanism. And while we have a lot of uncertainty today, it tends to price in good news on a go-forward basis. So our third theme is basically this. Any market uncertainty will likely be very short-lived. Again, that's our third theme. First theme is the Fed pauses, higher for longer. Second theme is market uncertainty. Third theme, the most important theme, the positivity, the positiveness, the positivity that we have is that any market uncertainty will be short-lived. So let me talk about this in terms of why, why we do think that the market could, with a pullback, be setting itself up for a better 2024. So if you look at this next slide here, this next slide kind of points out why the trouble could be behind this. The good news, and I alluded to this at the beginning, is that the data is getting better. The economy, the economic data is getting better. So you look at this slide. This is the economic surprise index. So every time a data point comes in better than expected, the line moves higher. Every time it comes in lower than expected, the line moves lower. Pretty straight. But what you see on the right-hand side, the data has gotten better and better and better. That's good news. And that's important because as economic data gets better, then companies sell more stuff. They sell more stuff. They generate more earnings. They generate more earnings. Investors buy the shares of those companies. Remember the whole point. Stronger economy equals stronger potential earnings and a potential stronger stock market. So our key point here is that a lot of the bad news, a lot of the surprises are starting to come into our data right now. And case in point, earlier this week, we saw third quarter GDP. And so GDP, gross domestic product, this is the economic output of our country, came in much higher than expected on strong consumer, strong retail sales, strong economic data, which will flow into the fourth quarter. Again, stronger economic data. So what's also driving some of this, these upside surprises? You look at this slide, and we sort of what we envision is like a sector recession. And what we're seeing is that areas of the economy that are in recession today are starting to stabilize, if not actually recover. So let's talk about this for a second. One thing we've been telling you for a while is that if we have a recession, if the recession comes in, we expect the recession to be a very mild recession. Again, if, I'm not saying we have one now, but if a recession is around the corner, it's going to be mild. And the reason we say this is that we envision what we call a sector recession. A sector recession is a recession that rolls through the economy sector by sector by sector, but doesn't hit the economy all at once. So let's think about this. What's in recession today? You have manufacturing, you have housing, you have autos. What's not? Consumer spending. We as consumers are spending money like crazy. So housing is in recession. You look at this chart. This chart shows new home sales. You see the line. Housing has come down, but now it's starting to stabilize and improve. Again, an area in recession today is starting to stabilize. Hence, the data is starting to get a little bit better. Or auto sales. Auto sales have been in recession for a long time. Now they are starting to stabilize. They're still well below the 2019 levels. 2019 was when pre-COVID levels, but they're rising dramatically. See on the right-hand side, autos are in recession. They're getting better. Another area in recession, manufacturing, the production of goods out there. Manufacturing has been in the doldrums for such a long time. You look at the right-hand side though, spending on manufacturing facilities is surging. Yes, parts of it is driven by the CHIPS Act, by IRA, all these different acts out there to help drive manufacturing. Good news though, areas of the economy today that are in recession are getting slowly better or stabilizing. The other part of the sector recession is that the areas not in recession will likely start to slow down while those areas in the recession start to recover. You see that? It's like a sector recession that rolls through the economy. So one area that's not in recession today is consumer. We are spending money like crazy. Part of the reason is that you look at this slide, debt as a percentage of disposable income. Basically, how much debt do you have? How much income do you have? The debt as a percent, the debt is a numerator, and here's the denominator is income. It's actually come down. So therefore, we are in better shape from a debt perspective. Also, you see that inflation is slowing down. Wage growth continues to be pretty strong. I know there's some headwinds coming down the road, including student loan repayments, tax bills due here in California in October. Savings rates are coming down, but that's our perspective of this rolling recession. Areas in recession are starting to stabilize. Areas not in recession are starting to slow down. This rolls through the economy. We don't have a nasty recession where everything falls at once. Another thing helping the consumer right now, you look at this slide, the labor market. The labor market is pretty strong. Right now, the slide shows the number of jobs out there relative to unemployed people. At the beginning of the year, it was 2 jobs per person. Now it's about 1.5. There's plenty of jobs out there. This is good for the consumer, good for stability. Another reason why trouble could be behind us is this. And this is a kind of a boring slide. This shows earnings for the S&P 500 quarter by quarter. So last quarter, we had a really bad quarter for earnings. Earnings were negative down 6-7%. Earnings this quarter should be flat. They're actually coming in better than expected. At the beginning of this quarter, the markets expected earnings to be down 1% for this quarter. Now, at last case before this presentation, earnings are expected to rise about 3%. And again, as we get more data points, earnings should continue to move higher. But the more important point is that earnings quarter by quarter are looking to improve year over year. This is good. This is why trouble could be behind us. We've seen the worst in terms of earnings behind us. Also, you look at this slide, profit margins are stabilizing for companies. So profit margins basically help to drive corporate earnings. And one way to measure how profit margins are they going up or are they going down is simply taking PPI, the producer price index, so these are business costs, and CPI, the consumer price. This is what businesses sell goods to us, basically. And the spread, it sort of indicates which way profit margins are going. What this line shows, the light blue line, is the producer price index, the business costs. It's falling at a faster rate than the purple line, which is what companies are selling goods to us. So the good news is that profit margins are stabilizing. They were much higher, but now they're starting to stabilize because business costs are falling at a faster clip. So with all this said, listen, we have three themes, and our three themes are number one is that the Fed pauses but maintains a higher for longer perspective. So again, what that means, the Fed is done raising rates in our opinion, but keeps rates higher than the markets had anticipated. Our second theme is that markets have gotten a little ahead of themselves. The stock market is sort of ignoring a lot of the bad news out there. Sooner or later, and we're seeing it right now, is that basically volatility, weakness, uncertainty will impact the markets. Our third theme is the good news, is that even with this market pullback, even with this market volatility, we expect it to be very short-lived because lots of fundamentals are improving, especially for 2024 around earnings, around recovery in areas of the economy that were in recession, and just the strength of the consumer. So what do you do? What do you do in this type of environment that's going to be, in our opinion, volatile and better? You got to do three things. Number one, be diversified. Diversification. I know in a period like this where everyone's talking about tech stocks and AI and how great they are, and yes, there are some merits in some of those companies, but if you look at this slide shows the PE ratio, remember the valuation of different parts of the stock market. The big purple line on the top is the valuation for growth stocks. These are these technology stocks. And you see the long-term average is 21.7. Today, the PE ratio is 30. It's much more expensive than the average. Other parts of the market, like value, like small cap, like international, are much cheaper. So valuations are not necessarily a reason why you buy companies, but this just shows you, be diversified, have exposure to different parts of the market. Our second takeaway for you is make sure your portfolio is in line with your long-term investment objective. Don't be too aggressive. Don't be too conservative. And how do you make sure of this? Work with your advisor here. Work with your advisor you're using. Make sure you update your perspective. Anything changing about you, anything, whether it's you're retiring or other thing, or are you planning a new vacation, whatever it is, keep them updated because they need to make sure your portfolios are in line with your long-term objective. And the third thing is important. Market volatility. These big swings in the market are going to be with us for a long time, but it's a normal part of investing. Think about this. In the last 42 years, the stock market has been up 29 of the last 42 years. So the stock market generally has a positive bias, but the average intra-year loss, that volatility in an average year, is down about 14%. So volatility, market swings, these pullbacks, it's a normal part of investing, and you need to take advantage of this. Diversification, dollar cost averaging, all these investment ways of investment processes are great to take advantage of this. So I know I went through a lot of themes, and I know a couple of them were a little cautious, but I just want to say, I wanted to bring this in because we are talking about the Grateful Dead, but I'm not bearish. We're just a little cautious near term, a little cautious, but we do see some opportunities around the corner, especially late this year and next year. So if I kind of take everything and wind it together, I think in the song Touch of Grey by the Grateful Dead, and I think Grateful Dead can inspire us here with a very simple lyric. Again, this ties all of our themes together. So the Grateful Dead in the song Touch of Grey said this: every silver lining's got a touch of gray. And I think in this case, the Grateful Dead is speaking to you and to me, especially to you as a client. And what they're saying is this: we have three themes. The Fed is pausing, higher for longer, markets are ahead of themselves, but any uncertainty will be short-lived. So again, any touch of gray every silver lining has a touch of gray. But I really think a better line for the Grateful Dead would have been this: every touch of gray has a silver lining. Yes, we have some near-term clouds right now, some uncertainty, especially around, the events in the Middle East, especially around geopolitical risks, especially around potential recession, the Fed. All these things are overhanging us right now. But the good news is that valuations have come down a bit, that the stock market looks a little more attractive, earnings are getting better for next year, and more importantly, the data is getting better. So whether or not we have a recession, it's going to be mild in our opinion. So with that said, I want to thank you. If you want more information, please follow my team on Twitter at Cetera IM. Please follow me on Twitter, Gene Goldman. I do thank you so much, and I have to go through these disclosures. I will not read these to you, so thankfully I don't have to. So a bunch of disclosures for you to enjoy. Thank you so much. And with that said, that's it for my presentation. Thank you.